Welcome back, guys, and in this video we're going to be talking about candlestick formation. We have been wondering what are these green red candles looking like diagram on the charts that we have been showing in the previous videos. Don't worry, in this lesson you are going to know everything you need to know about candlesticks. So without no further delay, let's get into it. Candlesticks charts are a type of financial chart for tracking the movement of securities. They have their origins in the old Japanese rice trade, and they have made their way into the modern day price charting. Most investors and traders find them visually appealing than the standard bar chart, and the price action is really easier to interpret. So what we have been saying in previous videos, let's clear this up. We have been saying things like this, right? Green, red. Some are big, some are small, some are tiny, some have this long pin-like looking bottom, pin-like looking top. So all these things are just interaction between buyers and sellers in the market, and I will show you what it entails. For a candlesticks, there are four major parts. It is called OHLC: opening price, closing price, high price, and low price. Let me give a scenario. In the market, when I say markets, not our normal markets, not where you buy food. I'm talking about where you buy securities, where you buy assets digitally, where you buy cryptocurrencies, and where you sell them to. Opening price is the first price an asset was traded for during a trading session. For traders, markets usually open depending on where you are staying across the world. It might be Nigeria. So in Nigeria, market opens around 1 a.m. So 1 a.m. that would be when the markets will open. The first person to buy a particular product or to buy a particular coin, that price that he bought it for would be the opening price. Let me use a normal market scenario so you can understand this better. So I'm going to the market and I want to buy mangoes. So I got to the market around 7 a.m. when they opened the market. So I was the first person. Each unit of mango, I bought it for 50 naira, right? Or we can say $50. I was the first person to buy mango that day. So the opening price will be $50. Are you getting it? That's the opening price for mango as of that day, as of that trading session. During the trading hours, some people that don't know about the market came to the market maybe around 10 a.m. after I have left the market, and they wanted to buy mangoes too. So when they got to the market, definitely they don't really know about mango market. The same trader that sold to me for $50 per mango now is telling them $70 per mango, maybe due to high demand in the market. So now they are buying the same mango I bought for $50 around 7 a.m. They are buying it for $70. So that point, that was the highest the price got to that day. That would be the high price. Do you understand? So we've talked about the opening price, which is the first price I bought the mango. The high price, which is the highest mango got to that day, which was $70. Now remaining the closing price and the low price. And some people came into the market, they know the market better than I do, so they were able to negotiate the price and they bought that same mango for $40 each. Now the same mango I bought for $50, they bought it for $40. That $40 now represents what? It represents low price because that's the lowest someone bought mango that day. So we have the opening price, which was the first price I bought mango. We have the high price, which was the highest price someone bought mango, and then the low price was the lowest price someone bought mango. Then we have the closing price. So let's say around 8 p.m. when the market is about to close, the last person that bought mango bought it for $60. Now let us relate this to a candlestick in the market. This is what candlesticks look like in the chart. I'm going to be explaining how those four major parts fit into this, and that's what we have in the course here. You can see what they look like. We have the red, we have the green. The red represents drop in price. The green represents increase in price. This is a green candle. This is a red candle. So from the old green thing that you are looking at is the real body. It's called the real body. Then we have the high price, the close price, the open price, and the low price. So I want you to pay attention to this part because it is very crucial for this course. So the first person that bought mango bought for $50. So this area is the opening price, which is $50. Then some people came into the market, bought each mango for $40, which is the low of the day. Can you see? So this wick here represents the low of the day. Do you understand? The beginning of this green place is where the opening price is, which is $50. Then below that is this wick. It's called wick. This line that you're looking at is where the low is, which is $40. And then we have the high because someone bought for $70. I hope you are taking note of this because you need a little bit of note taking to understand this better. So we have the opening price, the low price, and the high price, which is $70. Some people bought that same mango for $70. This is where it's going to be. This line that you are looking at is the high of the day, which is $70. So at the end of the day, the other person that bought mango before the market closed bought it for $60. So this is $50 opening price, $60 closing price. Do you understand now? At the end of the day, so when we're analyzing in the market, we are going to say the price of mango increased on that day. Do you understand? Because the closing price was higher than the opening price. The opening price was $50, closing price was $60. We had an increase in price, and when you have an increase in price, your candle is going to be green. So this candle you are looking at is just 4 points: the opening price, the closing price, the high of that day, and the low of that day. So because the price increased from $50 to $60 at the end of the day, forget about the high and the low. You want to know where it opened, where it started selling, and where it ended up on the price level. Do you understand? So that's the real body. The real body represents the opening price and the closing price. On the other hand, for a red candle represents drop in price. It means decrease in price. Let's say the opening price is 60. The first person that bought in the market bought for 60, and then the closing price, let's say 40. So now we know that price dropped during that day, even though some people bought that same mango as high as 70 and some people bought as low as 30, but the closing price was 40 and the opening price was 60. So we have 60 as the opening and then the closing is 40. It means price drop for that day. That's why we're having a red candle. And what's the difference between the red candle and the green candle? The real difference between the green candle and the red candle is that price increased for the green candle and price dropped for the red candle. So the opening price is always lower than the closing price for a green candle because price went up. That means the first price they bought a particular product is lower than the last price they bought that product, which means price increased. So you bought 50 and closed at 60. So you can see the opening price is always lower than the closing price. For a red candle, the opening price is higher than the closing price because price dropped. The first price they bought a particular product is higher than the last price they bought that product. So the closing price is lower. For the green, the closing price is higher because price went up. For the red, the closing price is lower because price went down. I hope you understand this. So let's look at this in real life scenario. So this is Bitcoin chart. So each candle now represents a day, right? We're on the daily time frames. Don't worry, we are going to be setting up this trading view platform later in the course. So right now, we are going to be analyzing this red candle. Remember, I said for a red candle, the opening price is always at the top and then the closing price is down here. Are you seeing it? So now we have the opening price here, right? That's the opening price. We have the closing price here, right? Can you see? The opening price is higher than the closing price because price dropped. Price moved from this region down to this region during that day. Do you understand? So price moved from the opening price, which was 9,900, down to 9,200 that day. So the opening price is higher than the closing price. Do you understand? So the highest Bitcoin got to that day was 9,980. The opening price is 9,000, about 9,900. Then the closing price is what? 9,272. Then the low price is what? The low price is $9,080. Do you understand? So those are the 4 price points. This is the high, the opening, the close, and then the low. Those are the 4 price points. So for a green candle, let's analyze a green candle. So this is a green candle. Let's use this big one. So this is a green candle. We know that a green candle, the opening price is always below the closing price because price went up. So price went from this area, price went from this opening price here up to this place. Do you get it? So this is our opening price, which is 9,298. This is our closing price. Remember, the opening and the closing price is the real body of the candle. So this is the opening and then this is the closing. I'm really emphasizing on this because you'd really need to get it. So now this is the closing price. The closing price is higher than the opening price because price went up that day. Do you understand? So the closing price is 9,697. The highest Bitcoin got to that day is this week. So here at the top is what? 9,797. And then the lowest Bitcoin got to that day is this little thing here. That's the lowest it got to, which is 9,284. Do you understand? Let's talk about the key concept. If the closing price is above the opening price, then a green candle is displayed. It means the price went up, right? If the closing price is below the opening price, then it is a red candlestick that will display. Do you understand? That means price went down. The colored part of the candlestick is referred to as the body. Remember, the colored part is referred to as the body, and this body represents just the opening price and the closing price. Do you understand? So the top of the upper wick represents the high price. I already showed you that this wick represents the high price. Then the bottom of the lower wick represents the low price. Here represents the low price. I hope you guys are getting it. So the longer the body of the candle, the more the activities of either the buyers or sellers, depending on the color. So if the candle body is really big, that means there's huge difference between the opening price and the closing price. So let's see that on live charts. So the big candles, you can see the price difference between this big candle from the opening and the closing is this. That's about 4%. Can you see that? And here, let's pick a smaller candle. A smaller candle is this. So the difference in price, in the opening price and the closing price is 0.7%. Can you see? Do you understand what we are saying here? The bigger the candlesticks, the bigger the price difference between the opening price and the closing price. Do you understand now? I want you to take note of one important key concept. The end or the closing price of a previous day will be the opening price of this current day. So if the price closed at $10,000 yesterday, it means the opening price of today will be $10,000. So price usually open where the previous candle closed. This green candle, for example, it opened here, it closed here. The next candle to it, which is red, opened here, but because price dropped, that's why we have a red candle. You can say, so price opened here, closed here. Do you understand? The next candle opened where this one closed, and then it's closed here. It means price is currently dropping. Then the next candle opened here again, and then dropped. You can see here, price opened here and closed here. When it closed, the next day, price opened where this one closed, but because price increased that day, that means the opening price was below the closing price, which means price went up. That's why we have a green candle. So price opened here and closed here. The next day, price opened where this one closed and then went up. The next day was a red candle, price dropped. The next day, green candle, price increased. Next day, price dropped. That's how you know or how you read candlesticks. It is that simple. I hope you guys now understand what candlesticks are. They are just activities between buyers and sellers. 4 price points: the opening price, the closing price, the low price, and the high price. Remember, the real body represents the distance between the opening and the closing price, which is really important. The pin looking like thing below the body and above the body represents high and low. Do you understand this? Now that we understand trend lines, we understand trends, we understand support, we understand resistance, we know how to read candlesticks, but we don't know the type of candlesticks that we have in the market. You can see there are different sizes, different types, and I'm going to be talking about those in the next lesson. So take a coffee and I will see you in the next video.